I want to bring in BlackRock Global co-head of iShares Fixed Income ETFs, Steve Laipply, and trader Scott Redler. Guys, it's great to have you here. And Steve, I want to start with you on something. The Wall Street Journal editorial board writes this about what we saw yesterday, and that is Jerome Powell and tariffs. And he said tariffs give the Fed an inflation foil. They say President Trump likes to blame Fed Chair Jerome Powell for any trouble in the economy. But on Wednesday, Mr. Powell was able to blame Mr. Trump's tariffs for at least some of the anticipated inflation rebound.
Yeah, so look, I think inflation has been bumpy. It's going to continue to be bumpy. We've been saying for a couple of years now that the glide downward was going to be uneven. We're seeing that stickiness play out. Tariffs can be, a one-time adjustment, but, the market has reacted to that. The front end of the curve in terms of inflation expectations has widened out. Nonetheless, we've seen pretty amazing flows into bonds. So just first 2 months of the year, we saw $100 billion come into fixed income ETFs. Same time last year, that was 60. So it shows you that despite the volatility, people are going into fixed income and trying to lock in these yields. We were at the same level of 10 years, roughly within 10 basis points a year ago.
You do have some concern, though. You've got some concern about debt, and I'm going to get to that with you for sure, because I read your research note. But Scott, really quick, you don't think that the lows of 2025 have been hit yet?
It seems like the administration wants to bring the economy lower. They won't say it, but basically with tariffs, they want to slow the economy down. With DOGE, they want to limit the amount of federal government spending, which has been stimulus for the overall economy. So if they bring the economy in and they have this growth scare, which has been the narrative, that's why the S&P fell 10%. People thought Trump would come in, pro-growth, care about the stock market. He didn't do that. So that's why 9 to 10% came out of the market fast. Now, everyone's trying to figure out how slow do we go? What type of slowdown do we have? How many rate cuts will there be? Is it going to be 50 basis points, 100 basis points? So in a normal environment, you have a 10% correction. We've seen many of them. In the average pullback from the highs over the last 30 years, it's been 14%. We're not even at the average pullback after 2 enormous years. So to me, based on the action, it seems like we could have an oversold bounce like we just had. But overall, the lows for the S&P, in my opinion, aren't in yet.
Okay. Well, and look, pullbacks create opportunity. We understand that as long-term investors. But Steve, when you talk about the U.S. national debt, that's where you get a little cautious in your tone here. And you say, look, $36 trillion, fair enough, 6 times the $6 trillion that we had in 2000. But you also say, because that represents 124% of GDP, and the CBO is projecting that to increase, you say that creates a potential red flag for you. Can you explain?
Yeah, it makes it a little bit trickier in the long run. And so we were actually just speaking about this before the break. It makes it a little more challenging to count on the long end providing that traditional negative correlation with stocks, because ultimately investors have put in term premium into those longer dated bonds. Now, ironically, as we talked about just a minute ago, bonds have rallied so far this year. I mean, long-dated bonds, TLT, it's up almost 5% so far, while the S&P is down. But, it just makes it a little trickier to project that out, because at some point, attention starts turning back to that fundamental deficit concern on the longer end of the curve.
And who holds our debt?
Yeah, I mean,
who would that be?
Fortunately, it is held more broadly, but yes.
I mean, that's problematic as we look on the political side of the market.
Well, that's why politically it seems like Trump wants to get rates lower because of the debt to refinance it at a lower rate. We had our chance in 2020, 2021, and we were at like neutral rates. And when he wasn't president, he's like, hey, or maybe he was at the time, he's like, let's refinance our debt. So I think he wants to refinance our debt so interest payments are lower. And in order to do that, you have to unfortunately break something or do a detox, which everyone's been talking about, which means short-term pain for longer-term better times. So if he in the first 6 months could bring the economy down, rates lower, refinance the debt, get a 15 to 17% correction in the equities market, and then call the Trump bottom, and we see that, then the second part of his term might be viewed a little bit more positively than having the tough love now.
And we've heard that from Howard Lutnick. We've heard that from Scott Bessent, that, short-term pain for long-term gain. I think the question mark for the U.S. economy and for investors is how much pain can they take. Some of us have thresholds. Just going to throw that out. But you say that at some point you think the administration is going to shift. What do you mean?
Well, when rates have come down, when expectations for maybe 100 basis points of cuts or more, or maybe we get to a point in the market where you have capitulation, we're down more than 15%, not just a normal correction, then his
They pay
number is going to go down. He's going to be like, all right, he's going to take care of business.
Yeah.
He's going to call, on Powell. He's going to do whatever he wants to do in order to maybe lift some tariffs, right? He has that lever. Every time things get bad enough, he can lift some tariffs, and then all of a sudden we rally. And then at a spot in the market, in the economy that I guess everyone deems a worthy spot for that inflection point. But again, it's been 3-4 weeks. So this can go on 3 to 6 months. April 2nd is right around the corner. That is the next vocal point. Is that the starting point for negotiations, or is that going to be like buy the news, sell the rumor, because April 2nd is when all those reciprocal type taxes or tariffs have to be put in place?
How would the bond market react to that?
I think long term, people are focused on the fundamental. You haven't had yields this high in 20 odd years, right? And so I think there will continue to be volatility as we sort through tariffs, as we sort through where will core inflation ultimately land. But investors are allocating. And so what we've been saying is, don't try to call the top or bottom in rates. If you are concerned, we talked about some of the structural things, just allocate into the income part. Go shorter, rein in your duration, lean into income, clip those coupons. That's the best way to sort of mitigate through a lot of this noise, is just to bank the cash.
Yeah, but look, diversification might be a good game to play over the next couple of months as we try to kind of navigate all of this. Guys, final word.
Asset allocators are winning. If you're 10% in gold, you're making money. If you're in bonds, you're making money. If you're in equities, you buy the pullback. That's why you have that pie chart, right? In BlackRock, you have the pie chart where you have distribution amongst your assets. So they're winning because one spot is doing better than another, and then all of a sudden it equals out and you make money and build wealth long term.
There you go. Scott Redler, Steve Laipply, it's great to have you both here on set. Appreciate it.